Well, glad to have you back. Nigeria's headline inflation rate decreased to 32.15% in August 2024, despite the recent hike in pump prices of petrol nationwide. The latest data from the National Bureau of Statistics showed that this figure represents a 1.25 percentage points decrease from the 33.4% recorded in July 2024, and the second consecutive monthly slowdown in inflation after a persistent rise in nearly 2 years. The NBS and its Consumer Price Index report posted on its website on Monday said the drop also signaled a slower pace in increase in average prices levels compared to the previous month. Mr. Temitope Omosuyi is an investment strategy management senior associate with Afrinvest West Africa. He joins me live from the United Kingdom. Good afternoon, Mr. Omosuyi. It's good to have you on the show.
Good afternoon, Tolu. Thank you for having me.
Well, we see that inflation has declined 2 consecutive months. I'm interested in what you were expecting and what do you think could be responsible for this?
All right, thank you, Tolu, for having me once again. Well, we saw the decline in inflation to 32.5% from 33.5%, all the way from the peak of 34%. That it was likely expected because if you look at the base effect, in a way, it contributed to the decline in inflation that we saw. In addition to that, you're already entering harvest season. So all of that contributed to the decline in inflation. However, if you check month on month, well, that also showed some level of deceleration from over 3% prior to the 2 months of deceleration that we have seen to 2.2%, right? Although that is still elevated compared to what will bring inflation to a path that we think is sustainable.
Are you there?
Yes, I can hear you.
Okay, good. So it's good to start on that note, but many would also say that are we feeling the impact of the hike, of course, in pump price? Have we started seeing that on the inflation figures?
Well, thank you for that question. I think it was a major surprise for many to see that inflation has continued to decelerate, especially for last month. And despite the increase in fuel price, for instance, this year so far, we have seen about 15% increase in the price of PMS to about 700, and the adjustment that we're expecting to 900, 1,000. That means we're already talking about nearly 25 to 30% increase, right? But then the impact may not be so apparent on the numbers that we saw for August. We can begin to see much of that in September this month when the report will come out in October. But then I want you to also emphasize that prices of items have gone up substantially. If you look at the price watch published by the NBS alongside CPI, the NBS has some selected commodities that they typically publish regularly. It shows that within the last 2 months, prices have doubled, have increased more than doubled across major items, especially food items, right? So that mirrors exactly what is happening or what Nigerians are experiencing. But for the impact of this recent jump in PMS price to inflation, yes, it's going to affect what we see going forward. I think the only caveat is that the impact of base effects, the fact that we are seeing some interventions from the fact that government is supplying fertilizers to some farmers and other interventions in terms of the removal of import duties, all of that may provide support, which would somehow reduce the impact of this PMS on inflation. Ultimately, and I also suspect that sellers are also a bit reluctant to push up price substantially because consumers have been grappling with consistent increase in prices since 2022, and it's very important to also know that what we are seeing today, we saw episode of that in 2022 when inflation decelerated all the way after the COVID, right, 2021 all the way to 2022. But immediately Russia invaded Ukraine in February, right, we saw inflation jump substantially in March 2022. So a repeat of that is what we are going to see now. But why this time is different is because, you know, in 2022, like I said, inflation was already on the decelerating path. It was already around 15% before we now saw a surge in crude oil prices, we saw a surge in PMS price and other items. This time, we have been seeing consistent increase in inflation since 2022. So the fact that consumers are also laid back because they would continue to challenge producers in terms of how much of prices they can increase. And, you know, producers would also want to sell. They are currently grappling with a pushback by customers. So all of those factors would reduce the level of adjustment that producer can put this PMS increase in price on general price level. So I think to an extent, this will affect inflation, but maybe not as much as the experience of what we saw in 2022. And even if we see just 2%, 2.2% month-on-month increase in inflation, we are still likely we're still going to see about 31% inflation rate by the end of the year. And if we miraculously get about 1.5% or 1.6% in month-on-month inflation, maybe before the end of this year, we would talk about a 25, 26% inflation. But by and large, inflation is expected to just stay elevated above 25% by the end of this year, and the impact of other factors like we talk about flood in the footbed region that is affecting that is going to have material impact on inflation, and exchange rate is also a bit of challenge that we have to watch, because if you look at the breakdown of those inflation numbers, you see that despite the deceleration that we saw in August, imported food inflation remained elevated. In fact, came at about, went up by 34% year on year. That's for imported food inflation. Though general food inflation is still well above 36, 37%. But the trend has been encouraged, because if you look at the trend from 40% right now, so if you pick all of these factors together, the fact that there's flooding in the foodbed region and the exchange rate component, because naira to dollar and other currencies still elevated. So if you pick all of these factors together, you know, it might, you know, suggest that inflation will stay a bit elevated for this year. Maybe next year we can begin to see some positive impact of some of the policies that we are seeing at the moment.
You mentioned interventions which are very critical at this time, considering the effect of what we face as a country, fallout of subsidy removal, exchange rate, and all of that. But specifically, you talked about fertilizers, talked about seedlings being donated by government and all of that. I'd like us to look at some specific interventions that you also think can impact on people. You know what is going on here. You get the feedback. You're following the news. How do you think government can properly, you know, get to those people that need to get this support from them? What sort of intervention are you thinking? Are you suggesting for government moving forward?
So I think that, like I said, people are not really feeling the impact of the 2 months consecutive decline in inflation, right? And we have seen a bit of interventions here and there, from the fertilizer distribution to farmers, the fact that import duties has been removed on certain items. But then, you know, inflation is still elevated. So I think on the one hand, we are seeing the move by Monetary Policy Authority to keep interest rates elevated. It's quite obvious that much of this work must come from the fiscal side, right? The elevation or elimination of tariff is a fiscal policy. Direct intervention by giving trucks and fertilizer is a direct policy. So that should be sustained, and we have a lot of beautiful policies. I think the most important thing right now is to ensure that these policies are followed to the letter, from the policy and program formulation or development to the execution. The government has to follow to ensure that every fertilizer given to farmer is not diverted. Every intervention, food that is available at food banks are distributed adequately. So I think all of those policies are really important at this point. But more importantly, because no intervention is sustainable, someone must pay for every intervention. More importantly, on a sustainable part, we have to work on how the Nigerian economy can become so buoyant such that affordability will not become a concern. If prices are elevated and people can afford it, you won't get to hear complaints. The impact will not be so dire on the lives of people. In other words, policies must be geared towards economic growth such that minimum wage will be looking at over 200,000, 300,000, even a million naira, and is a function of the capacity of the economy, right? So on the short-term strategy, we're already seeing a couple of them, from subsidy, you talked about subsidy earlier, from subsidy, right, a bit because government is currently not passing the total price of PMS on people, So once we see subsidy in certain areas, but on a long-term basis, we still have to ensure that minimum wage goes up, and that depends on the capacity of the economy. And I really understand why the CBN came up with a policy for banks to be recapitalized, because the strength, the potential of the Nigerian economy, right, depends on the capacity of the financial sector. So if the financial sector is so buoyant, they are able to provide funding for the real sector of the economy. And once the real sector of the economy is performing well, labor can also get a better wage, because the only sustainable way, the only sustainable path to ensure that people can afford things in Nigeria is to get a better wage. Other interventions are short-term, and most of the interventions we see around would only continue to affect government fiscal deficit massively. And once government fiscal deficit is widening, their condition of debt stock would continue to go up. And, that's also another complication. We don't want a situation where government debt will be so high to the extent that we enter a debt trap, a situation where we would not be able to repay. So it's a very delicate balance such that interventions must be short-lived, but the economy must be put on a sustainable path such that people can afford basic things. Even when prices are rising, wages are also rising by that proportion. And that's what is keeping advanced economies afloat. When prices are jumping up, wages are also growing by almost equal proportion. So these economies are able to stay afloat.
Well, it sounds so interesting. But let's look at moving forward. We expect the MPC to sit on Monday and Tuesday next week. It's official. They said that's going to happen. Considering this shift in inflation, do you think that when they sit around that table on Monday, they will think of retention or another shift in rates?
So I'll think that the current inflationary trend seems encouraging. I know that the Monetary Policy Authority will want to look at a lot of factors. The inflation we just discussed is a very important indicator to watch. They would also look at the trajectory of foreign reserves. Right now, the reserve is at gross reserve, $37 billion. That seems to be the highest level since Q4 of 2022. They would also look at what is happening to economic growth as well. Last growth number, we saw that it was slightly above 3%, and the Purchasing Managers Index, which also measures the activities in the economy, or with purchasing managers. When purchasing managers buy a lot, when they do a lot of activities, suggests that the economy is thriving. So between June of last year and June of this year, we have seen that the index remained at contraction point below 50. But we saw a blip in August. That suggests that, activities have improved. So I believe that because the economy we have seen major increases, and I think that the Monetary Policy Authority would want to wait to see how far all of this would impact the economy. Rather than increasing interest rate, they will want to see, okay, inflation is trending downward, and we have to wait. They would want to wait for, the impact of what the fiscal authority is also doing. So ultimately, I believe that it's going to be a hold, because an increase in interest rate at this moment would only need a bit of dislocation in the economy. And if you want to look at it on an international standard, we are seeing some rate cuts happening in advanced economies. The conversation about high interest rates
last 3 weeks, you will say that, well, the